Good afternoon, all. I welcome you all on behalf of PCSIC on this 27th Startup Funda webinar. This time we are covering the topic called term sheet for funding, and this is very important topic from the startup point of view who are looking for fundraising and dealing with investors. So I think this today's topic is very important. Before we start our webinar, I just want to introduce you about the PCSIC for those Facebook Live users who are joining this webinar for the first time. Pimpri Chinchwad Startup Incubation Center is a business incubation center, which is a joint venture of PCMC Smart City and Auto Cluster, supported by Maratha Chamber of Commerce, and we offer our startups the basic business support like office space, mentoring, one-to-one mentoring, networking opportunities, and knowledge enrichment sessions like one which you are doing now, Startup Funda. So these facilities, as is a government initiative, are free. We don't charge any charge for this support. So those users who are planning to start startup or who are entrepreneurs, my contact number is given in the chat box. So you feel free to call me. So today we got a speaker, which is last time also we have same speaker and the same like topic in from funding only. So today's important topic is covering his term sheet, and his name is Hemant Kelkar. He is a co-founder of Startup Legal, legal professionals with rich experience of 12 plus years and knowledge of law, technology, and business operations, cutting across various industries and sectors. So basically, he has got a lot of flavors in his thing. Like he is a law expert, also technology and business operation expert also. So about Startup Legal is a group of passionate legal professionals providing comprehensive legal solutions to startups and SMEs. So his service will be valuable to many of you down the line. So with this small introduction, I will hand over to Hemant for his presentation. Hemant, over to you.
Thanks a lot. Thanks a lot, Uday. First of all, welcome everyone to this session. And, we all have PCSIC to thank for organizing these sessions. And it gives us an opportunity to interact for us as professionals to, extend our help to startups and SMEs like you, and for you to benefit from these sessions in whatever way we can add value to you. So last in the last session we looked at legal due diligence, which is done before funding. So I see some familiar faces who were there in the last session also. Now, coming to the next logical step in the fundraising process after, let us say, the first step is the term sheet. So what exactly is a term sheet? A term sheet simply is, uh, uh, a list of all terms and conditions on which a potential investor is ready to invest money in your startup or your company. Okay. The investment might be in any form. It might be in the form of, he might be acquiring some equity. Within equity, there can be normal equity, that is normal equity shares or preference shares. He might be subscribing to debentures that the company might be, issuing. So the fundraising can happen in a lot of different ways. Uh, and the first step is always a term sheet, which typically is proposed by the investor. He sets out his terms and conditions in it. And today, in today's session, we are going to look at these very terms and clauses in a typical term sheet. Uh, Given the paucity of time that we have with us, we have a very limited amount of time. So we'll try to get just a brief idea of each and every term. We may not be able to explain in depth what every term means. There are some slight mathematical calculations also involved in some of these clauses and terms. Uh, I'll be happy to share the slide deck with the PCSIC, who can then forward it to all of the people who are attending. So you can refer to those calculations. We'll not get into the calculation part right now. So let us start with the various terms. And again, one other thing. We will not cover absolutely each and every term that is there in a term sheet because some of them are pure informational terms. Uh, they do not have any legal significance attached to them. So we will look at those terms which affect your company as uh, the company who's getting that investment and also the investor who's putting in that money, right? So I'll just share the slide deck with you. Yeah, is it visible to everyone?
Yes, visible.
All right, great. So this is just a term sheet legal 101, meaning that we'll just cover the basics of what are the different terms in a term sheet and what they mean and what is their significance for each one of you, right? So we'll start. Uh, One of the most basic terms of a term sheet is a pre-money and your post-money valuation. Now, what exactly is pre-money valuation, post-money valuation? Pre-money valuation simply means the value that the investor feels what your company is worth before him putting in his investment in your company, right? So that is simply the pre-money valuation. Now, how this is calculated, this is done by way of a valuation process by a registered valuer. Okay. But it can also be arrived at by turning the formula on its head. So normally post money valuation is a function of pre money valuation and then the investment amount. So simply put, post money valuation is equal to pre money valuation plus whatever investment that investor is putting in, right? But if you reverse the formula, pre money valuation is obviously equal to post money valuation minus the investment amount. Now I'll try and explain each of these terms wherever possible with simple examples. Okay. Um, so let us say, let's take the example at hand. Now, let us say an investor is willing to put in rupees 20 lakh in your startup, and he's asking for 20% of equity. Okay. Now, if this is simple mathematics, if 20 lakh is equal to 20%, how much is 100%? So that comes out to a million rupees or 10 lakh rupees, right? As simple as that. Nothing very complicated or technical about it. I'm sorry, 1 crore. So that what we do is we first arrive at a post money valuation, which we arrive at by dividing the investment amount by the percentage being asked for. Simple mathematics, nothing else. So your post money valuation becomes 1 crore rupees, right? Now you have two components of the equation, which is the post money valuation and the investment amount. So post money valuation 1 crore, investment amount rupees 20 lakh, which means that your pre money valuation then becomes your 1 crore minus 20 lakh, which is 80 lakh rupees. So basically, the investor is saying that he considers the current value or worth of your company to be 80 lakh rupees. He'll put in his 20 lakh rupees, post which your post money valuation will become 1 crore rupees. Uh, every day you must be coming across so many different news where startups are raising money. So you'll come across a typical news item says, saying that so and so raises rupees or dollar, let us say a million. Uh, and now uh, the valuation, it is now valued at $100 million, something like that. So that is what they're saying in that news item is basically what is the investment amount and what is the post money valuation, right? So, and this keeps changing, right? And the entire funding or startup funding investment, uh, professional investors, for professional investors, this is the most important thing that they're looking at, right? So when they put in 20 lakh rupees for 20% right now, tomorrow when your company or your startup grows and then you go for a further round of investment, after that, if that investor, let us say he says that, okay, I'll put in a crore rupees, but I want 10%, it simply means that he is valuing your company at 10 crore rupees, which means that the 20% that the This investor who has put in 20 lakh is now how much? Is worth how much? It is worth 2 crore, right? So that's the game. So he has converted his 20 lakh rupees into 2 crore rupees. That's a 10x ROI, right? So that is the game basically. That is the startup investment and funding game. So that's as far as the pre-money and post-money valuation is concerned. Typically, like I said, wherever a valuation is being done, a pre-money valuation will be put in. Otherwise, the term sheet will simply say the investment amount and the percentage of equity that is being asked for, if at all it is equity, right? As simple as that. Now let's come to what are cap tables. Cap tables are basically capitalization tables. What these tables give out is basically how much percentage of equity each investor, including the founders, every shareholder basically is holding. Okay, so taking the previous example itself, let us say the previous authorized capital of the company. This is very standard. We all start out when we incorporate as a private limited company with the authorized share capital of 1 lakh rupees. That's 10,000 shares with a face value of rupees 10 each. Okay. And typically these are your normal equity. So before the funding came in, before the amount came in, you'll see that this was the cap table. So founder one, let us say, assuming there are two founders, founder one held 5,000 normal shares, equity shares, coming to a shareholding of 50%. Founder two held also the same. It was a 50-50% holding. Now, as in this example, if the investor wants 20%, okay, see, understand there are two things when it comes to shares. You will either be issuing new shares, okay, or you will be transferring existing shares, okay. But where the startup founders are not transferring a part of their shareholding, they will then have to first issue new shares. And how do you do that? You'll have to increase the authorized share capital of the company. Okay. Now, how will you do that? In what percentage, or in what proportion? So to give 20% stake to the investor, the company shall have to issue, again, simple mathematics. Uh, you know, if 80% is 10,000, then how much will be 100%? So it will be 12,500, which means that 12,500 is the total number of shares that the company must have, again, at the same face value. So your authorized share capital will go up from 1 lakh to 1,25,000. Okay. So you'll have to issue 2,500 additional shares, uh, which you will then, issue, or, uh, you know, uh, correct. So you'll issue to the investor, right? So the post effective date or post investment, what will be the shareholding? What will the cap table look like? It will be like this. So 5,000, what you originally held, and that's worth 40% each. The investor whom you issued these 2,500 shares, and these will be preference shares, will get a shareholding of 20%. All put together, as you'll see, 100%. Okay, 40, 40, and 20. That's how the cap table. Now, this is a very, very simple example that I'm giving. Uh, Imagine companies where, VC firms put in money, where there's a large group of investors who pull in their money and together as a lump sum invest in a startup. So you'll find that, and we have seen cap tables with 20, 25, 30 entries, where there are those many number of shareholders, and each shareholder has a certain amount of shareholding in that particular company. So cap table is extremely important. It One look at the cap table gives you the shareholding pattern of the company, who holds how much. Okay. And this is also very important for a lot of other reasons, because, see, there are certain rights which are assigned to certain shareholders. If you are a majority shareholder, you have certain rights. If you are a minority shareholder, you have certain rights. certain rights are also given to certain shareholders who have above a certain threshold of shareholding. So let us say you will get, let us say, a board seat if you have at least, let us say, 8% shareholding. So if you do not have uh, 8% or more shareholding in the company, you will not be given a board seat, even if you ask for it, right? So or if you currently have 10%, but if you transfer a certain percent of your shareholding and now your shareholding comes to below that 8% threshold, earlier you might be having a board seat, but then that board seat will be taken away from you. You will no longer be having a board seat because your shareholding came below that particular threshold, right? So there are a lot of other things also. For example, information rights, where we say that okay, if you'll only get information rights uh, if you have about, let us say, 4%, 5% shareholding. So one look at the cap table, and this is why the cap table must always be updated after every round of funding. This gets shuffled around and moved around a lot. Okay, and that's as far as the cap table is concerned. It's a capitalization table. Okay, now we have the various types of instruments. Okay, what do we mean by this? Now, like we saw, there are basically three types of securities or instruments that are issued by any startup in exchange for the investment that they get. Okay, the first type of instrument is equity. We all know that. uh, Again, in that there is a normal equity and there's a preference share. Okay, then there is debt, which can be simple loans, or it can be bonds, or it can be debentures. Okay, and then there are the hybrids. Now these are the most popular instruments or securities that are being issued by startups right now, and we'll see why. Because they offer benefits of both equity as well as debt. Now, what are the benefits that a debt offers to a lender? If you are a simple debt holder or a creditor of a company, if there is a liquidation of the company, you will be the first one to be paid out of the proceeds of liquidation, right? You will always have first right. So, in any case, your principal amount is always safe, right? That never goes anywhere unless, of course, the proceeds of liquidation are below your principal amount, in which case you will get the entire liquidation proceedings. Okay. Um, so that's the benefit that a debt gives. It's like a loan. A debt is basically a loan where and then of course it will be secured by a charge on some of the company's assets. It can be movable, immovable, anything. So when a company issues debt, typically it is secured. Unsecured debt is relatively, very rare, because it's very very risky. In that case, you'll obviously have to pay a higher interest rate. So in debt, what happens is you do not get growth, okay, but your principal amount is well protected. Okay, where okay, you say that you'll get a certain percentage of interest every year on your loan, or on the debt, but nothing beyond that. Okay. Now the what is the benefit in a debt is sort of a disadvantage in an equity, where if you are owning pure equity of normal equity or even preference shares for that matter, uh, there is no guarantee that you will get your basic investment back, right? Because if the tomorrow, today, if the value of the share is 1,000 rupees per share, tomorrow if the share falls and goes down to 10, you lose 90% of your value. Okay, there's no security against that. If you have subscribed just to a normal equity or just normal preference shares. Okay, now but on the other hand, so what is the benefit of pure equity? The benefit of pure equity is growth, right? So, okay, if you bought a share at a value of 1,000 rupees per share right now, tomorrow the company or your investment does well, that value might go up to 2,000, whatever, even 10,000. which means you get 2x to 10x to 20x, whatever number of times your investment that you put in, right? So you won't get an interest, you won't get liquidation preference, but you will definitely get a growth. There's always the probability. In terms of debt, there's no growth, you'll only get your interest. So it's a much more secure form of investment. Equity is a much more riskier form of investment, and they both have these contrasting benefits and disadvantages. Okay, now this is where hybrids come in. Now investors are extremely smart people. Okay, they want the benefits of both equity. Boss, if I put in 100 rupees, I want 1,000 rupees against that. Okay, so I want the wherever the company does well and there's a possibility of growth, I want to be part of that growth. But I also do not want the risk or the entire risk that comes along with it. I my principal amount at least should be safe to a certain extent. So how do I do that? So that is through these hybrid instruments. Okay, so there are debentures come and again, pure debentures is just debt. It is a loan, but compulsorily convertible debentures is a hybrid instrument where for some initial period of time, that debenture is treated as a pure loan and an interest is paid to the investor by the company. After some time, and at the option of the investor, let us say 3 years, 4 years down the line, whatever that conversion period might be, that maturity period might be, these debentures, this debt gets converted into equity. So the assumption over here is that, okay, you give a company 4 to 5 years, if they do everything right, it will achieve exponential growth. And at that time, I'm not happy or I'm not content with just the, whatever 5, 6, 7, 8, 10% interest. I want a 5x, 10x sort of a growth on my investment. Okay. So I'll say, you know what, now I want to convert my debt into equity. So that debt gets exchanged for equity shares. And, obviously by that time, the value has exploded. So the investor gets that benefit, where then he can then sell off his equity shares and make a fortune, right? So that is a debenture, a convertible debenture. Now there are also two, three different categories within this. There's a compulsorily convertible debenture, in which there is no repayment of the principal amount which is done. It compulsorily gets converted into equity after a certain period, and when that condition is satisfied. There is a optionally convertible debenture where the investor has the option of either converting it into equity or asking for an entire repayment of the uh, principal amount. Okay, so it will be treated as a loan, and he'll say, boss, you repay my principal back to me now after a certain time, because I'm not interested in converting this into equity. I want to exit. Okay, and while preserving my principal amount. And then there's a non-convertible debenture, which is just debt. Basically, it does not get converted into equity. Now there are also CCPS. This is amongst all these, the CCPS is the most popular option when it comes to investors when they are investing in a startup. Now, what is a compulsorily convertible preference share? See, a preference share, how it differs from an equity share is that it gets preference in the liquidation, in the event of a liquidation. So there is there's a clause called liquidation preference, which we will look at later on, where first, let us say a company goes into liquidation. The people who are the creditors, who are pure debt, who have given a loan to the company, they will be paid first out of the liquidation proceedings. Second will be the preference shareholders. And last, if anything remains out of the liquidation proceedings, the equity shareholders are, uh, you know, uh, given whatever amount might be remaining. So preference shares get that a preference in the event of a liquidation. They do not get voting rights though. Preference shares do not have voting rights. Okay, so there's a pro and a con over there. And compulsorily convert. You know what is a convertible preference share? Like we saw convertible debenture, which gets converted into an equity. A convertible preference share gets converted into normal equity. Okay. Now, within CCPS also there are these two further subcategories. There's a participating and a non-participating. We'll look at an example with that, and cumulative and non-cumulative. Okay, so uh, 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 on a cumulative one, whatever the interest which might be being charged, it gets accumulated over the years. Non-cumulative where, and one more thing in a preference share is that uh, some dividend which is paid on the preference shares, it is only payable in the case of a profit. So if in a particular year a company does not make a profit, a preference share will not get it. A normal equity share will not get a dividend. But a preference share, if it's a cumulative one, so whatever dividend was payable at X rate for that particular year, that will get accumulated till the time the company makes a profit, and then the entire uh, dividend will be paid to the preference shareholder. So that's a cumulative against a non-cumulative one. Participating, non-participating comes in the context of the liquidation preference event. We will look at that with an example later on. Okay. So these are different types of instruments. As startups, this is basically what you will be issuing to prospective investors against their investment. Okay. Yeah, so we look at now liquidation preference clause is again one that you will come across. Now, what is a liquidation preference? Like I said, when it comes to preference shares, the liquidation preference clause sets out the order in which the preference shareholders will be paid out of the liquidation proceedings of the company. Okay, so and this is where a participating and non-participating will come in. As I told you in the previous slide, it comes in the context of a liquidation. Now, your typical liquidation preference clause will state that in the event of in the case of a liquidation event, uh, the investor will be paid in so and so fashion. So first will be 1x. So whatever amount he is paid, okay, uh, till the time that entire amount is recovered, he will get first right over the liquidation proceedings. Of course, after the pure creditors. Okay, so that is first thing. And if it says it's a participating one, okay, then as we'll see in this particular example, they get to what we call a double dip out of the liquidation proceedings. So proceeds from liquidation in this particular example were, let us say, 50 lakh rupees. And again, we are taking the same example as earlier. The investor has put in 20 lakh rupees for 20%. Okay. Now, in case of simple non-participating preference shares, uh, this will be the order of preference. First, the investor. So, uh, and let me give simple explanation of what is a liquidation event. Liquidation event is an event where assets of the company are sold to raise money. Okay, so it can also be an insolvency event. That's also a sort of a liquidation event where all the assets are then auctioned or liquidated basically for in exchange for cash. Now let us say in that particular liquidation event, the company raised an amount of 50 lakh rupees. It got 50 lakh rupees against all the assets that it sold. Now, what will happen? How will this 50 lakh rupees be distributed? Now, the investor has a now there was a liquidation preference clause in the term sheet. Okay. The investor will first get, like I said, 1x. Out of this 50 lakh rupees, he will first, before even the founders, he will get his 20 lakh rupees back. Okay, out of this 50 lakh. Now, whatever is remaining, ये जो बचा हुआ है, वो फिर founders को जाएगा. And again, this is very very simple example कि जहां पे दो founders हैं या जो भी founders हैं और एक investor है, उसने 20 लाख रुपया डाला हुआ है and कंपनी ने liquidation event में 50 लाख रुपया कंपनी को मिला. ओके, तो वो 50 लाख में से 20 लाख रुपया सबसे पहले इन्वेस्टर को जाएगा. नाउ let us say the proceeds from liquidation were only 20 lakh. In that case, the investor will get the entire amount of 20 lakh rupees and the founders will get nothing. Okay, that is the importance of this clause, liquidation preference. That is why this is so important. This is basically the clause which preserves the basic capital that has been put in by the investor. वो बोलेगा कि यार भाई चलो ठीक है, कोई मेरे को 5x 10x ग्रोथ चाहिए था, वो तो नहीं मिल पाया, लेकिन चलो एटलीस्ट जितना डाला था पैसा उतना तो वापस आ जाए. तो उसके लिए ये लिक्विडेशन प्रेफरेंस का क्लॉज होता है, राइट.
What if
नाउ
debtors are not here, no?
yes, this is assuming there are no debtors.
Okay.
If there were debtors, तो सबसे पहले उनको debtors, I'm sorry, creditors. तो अगर creditors होते
Creditors. Correct.
तो उनको सबसे पहले जो भी है वो उनका whatever their loan amount was, वो सबसे पहले उनको जाएगा आउटस्टैंडिंग. एंड उसके बाद फिर अगर कुछ बचा तो उसमें भी फर्स्ट प्रेफरेंस विल बी टू द इन्वेस्टर. एंड दिस इज नॉट बिकॉज ही इज एन इन्वेस्टर, दिस इज बिकॉज he has preference shares. Okay, if the investor was holding normal equity shares, then this 50 lakh would have been divided in the proportion of the cap table, which is 40%, 40%, 20%. तो इन दैट केस इन्वेस्टर को कितना मिलता है? 20% ऑफ 50 लाख विच इज 10 लाख रुपीज. अगर उसके पास नॉर्मल इक्विटी शेयर्स होते तो. प्रेफरेंस शेयर्स हैं, इसीलिए उसको ये विथ लिक्विडेशन प्रेफरेंस क्लॉज पुट इन द टर्म शीट, उसको पूरा का पूरा 20 लाख रुपया पहले वापस मिल जाएगा. ओके, नाउ दिस इज नॉन पार्टिसिपेटिंग. नाउ सी पार्टिसिपेटिंग, इसमें तो और भी मिलता है, मतलब जितना डाला था उतना भी मिलता है, उसके और भी ही गेट्स टू डबल डिप into the liquidation proceedings. I'll tell you how. I'm sorry. Now same example, 50 लाख रुपया आया कंपनी को, एसेट्स बेच बाच के सब. नाउ सबसे पहले इन्वेस्टर ने अपना 20 लाख रुपया तो निकाल लिया उसमें से, ठीक है. बचा कितना? 50 लाख में से 20 लाख गया, 30 लाख रुपीज. दैट इज व्हाट इज रिमेनिंग. नाउ दिस 30 lakh rupees, if the shareholder, if the investor holds participating preference shares, then he will also participate in this 30 lakh rupees. How will he participate? In what proportion? In proportion to his shareholding. So he is holding 20% of the total shareholding, like we saw in the previous example in the cap table. So he will get 20% of this 30 lakh also. So that is 6 lakh rupees. And उसके बाद फिर जो बचा 24 लाख रुपया, that will go to the founders. Okay, so in a non-participating preference share, he got 20 lakh rupees over here. In a participating preference share, he got 20 lakh plus 6 lakh, 26 lakh rupees. Okay, so that is how these vary. Now, as a you know, am I audible?
Now audible.
Yes.
Okay,
Yes.
okay. So as a startup founder, you have to be very careful with terms like these, where it means, it says participating cumulative preference shares. So this is going to put on an additional burden on you. Okay. And it's obviously way more beneficial for the investor. Okay. I'm not saying that this is right, this is wrong. See, it all depends on how you are able to negotiate a particular deal. Okay, and I will stress a lot upon this throughout. Nothing in this is right or wrong. Nothing is good or bad. it all depends on the deal that you are getting, okay, and how you are able to negotiate. It might turn out that you don't have a choice, but you have to accept a participating in a cumulative preference share, uh, because the investor might be offering you some more value apart from just the money, right? So if he insists on it, you may not have a choice, but it's you should always know what it means, right? That's the whole point of this session. As startup founders, when you go for fundraising, and when a term sheet is proposed to you, you must know what every term, what every clause in that term sheet means, and what are its implications for you. What is its impact on you as a startup founder, right? So that's as far as the liquidation preference is concerned. And again, I've taken very simple examples because otherwise it will become very, very complicated, the entire calculation. Now, there's something called anti-dilution. This is also a term that you'll come across. Now, what
Yeah.
is anti-dilution?
Excuse me, sir.
Yes.
Before moving forward, can you take example of participating cumulative?
So, sir, cumulative is simply in terms of, see, a share has a dividend, correct? Holds a dividend. Now, uh, in a cumulative preference share, if you have issued a cumulative preference share, when is dividend payable? When the company makes a profit, right?
Right.
Right. So let us say if in a particular year the company does not make a profit.
Hmm.
In that case, if it was a normal equity, you would not be liable to pay any dividend to the investor. Correct.
Right.
But
Yeah.
if it was a cumulative preference share,
Hmm.
even for the year when the company does not make a profit,
Hmm.
you are liable to pay the investor the dividend at whatever rate has been agreed. Now, when will you pay it? अरे आपके पास तो पैसा है ही नहीं, कहाँ से भरोगे? तो आप कब भरोगे? When you will make a profit.
Right.
तो वो क्यूमुलेट होता जाएगा, accumulate होता जाएगा, इसीलिए
Hmm.
cumulative. Non-cumulative, it is very simple. The year you don't make a profit, you are not liable to pay interest or dividend.
Okay.
Okay, so
And
that's
It
the
will be
difference between a
and
cumulative
do
and
they
non-cumulative.
do they ask interest on that cumulative?
No, so there's a dividend. There's a dividend,
Okay.
right? So
Okay.
yeah.
and dividend will be paid at the same rate what you are paying the second year.
Yeah, so the rate is also agreed between the at the time of negotiation itself,
Okay.
whatever percentage he might ask for.
So the percentage of equity in the company and the percentage of dividend too, they
So
can be
sir,
different.
the percentage is simply on the amount that has been invested.
So somebody having like this 20% equity
Yeah.
is liable to get 20% of the dividend declared.
Yes.
Okay.
Yes.
So
Of course.
okay, thank you.
Yes.
Can we also take this question
Mhm.
as we are discussing CCPS? Can you also help us understand coupon rate and discount in those term sheets?
Correct. So what happens is basically the discount basically happens, and where it is applicable where you are given an option. ये कब आता है जब आपका टैग अलोंग या ड्रैग अलोंग का राइट होता है, या फिर यू गेट अ राइट टू buy further shares. Okay, that is where you say that I will buy at a discount of so and so so and so. ये typically debentures में you this is used where you say, see, let us say you're holding debentures, okay, and the now it is time to convert them into equity. Okay, now at the time of conversion into equity, the share price, the going price, the market price of per share is, let us say, 1,000 rupees. Now the discount, if you say that I'll buy it at a discount of 30%, it means that you will be issued equity shares at 30% discount below the normal market price, which means that you will be offered those shares at 700 rupees instead of 1,000. That is where you make your profit, or the investor makes his profit when he converts it into, see, because then overnight वो 700 रुपए में खरीदता है, but मार्केट रेट क्या है 1000 रुपए, तो सीधा सीधा उसको 700 का 1000 रुपए तो वहीं पे हो गया. And that is where convertible debentures are when they are converted, तो ये फायदा इन्वेस्टर को होता है. So that's the discount part of it.
That will be only for listed companies, I believe.
No, even for non-listed, why not? Absolutely, absolutely. Right. So coming to anti-dilution, now why is anti-dilution required? Again, this is for making sure that uh, his shareholding, when an investor invests money, and like we saw in the previous example, he's put in 20 lakh rupees for 20%. Okay. Now, if the company does not do well, and currently this investor, so he was issued, let us say 2000 shares and for 20 lakh rupees, so it will be around what, 1000 rupees per share, correct? Am I right? Or is it 100? No, 1000, right? So 1000 rupees per share. Now let us say the company does not do well and the share price goes down to, let us say, 700 or 600 rupees per share. Now the value of, of his shares, and so there's a down round. This is called a down round. Now what is a down round? Where the next round of fundraising happens at a pricing or valuation which is lower than your previous valuation. So in the previous round of funding, your share was priced at 1000 rupees per share. After that, things did not go as planned. The company is not doing as well as it should have, but an investor has still come forward and say, boss, you know what, uh, I know you raised your last round at 1000 rupees per share, but please understand that that is not a price that I'm willing to pay right now. I will only pay 600. Okay. So what will happen is that the previous investor who got only 20% for 20 lakh rupees. Now let us say, to simplify this example a little more, let us say that value comes down by 50% and the price per share is 500 rupees. So the new investor says, boss, I will buy your shares, okay, but I will only pay 500 per share. What will happen is he will also get 20%, but only at 10 lakh rupees, right? Or in that case, your shareholding or your price will come down. The previous shareholders, I'm sorry, the previous investors. Now, anti-dilution clause is a protection to investors when there is a down round. So there is an adjustment which happens under this anti-dilution clause, where there is a conversion price. That conversion price, the old investor also gets issued certain shares. So what happens is he is not that badly affected. It sort of protects him, protects his capital from being devalued to that extent, to the 50%. तो वो क्या करते हैं कि उसको थोड़ा और शेयर्स दे देते हैं at some price which is calculated through a formula, and that is how he is compensated basically, because the company did not do well. भाई मैंने तो पैसा डाला, मेरा पैसा थोड़ी डुबाओगे, मेरे को क्या करोगे, हाउ विल यू कॉम्पेंसेट, मेरा 20 लाख रुपए का 10 लाख रुपए थोड़ी करोगे, तो व्हाट विल यू डू, ओके मैं बोलूंगा सर ठीक है, मैं आपको और थोड़े शेयर्स दे देता हूँ, तो कितने दोगे शेयर्स, दैट इज कैलकुलेटेड वाया दिस एंटी डाइल्यूशन मेथड. So there are there are three formulas. One is a full ratchet. We'll not even go into that because it's no longer used. Then there's a broad-based and narrow-based weighted average. We'll not go into the calculation itself. It's a slightly complex. I'll provide the calculations to you. But basically, see, this is what happens. So let us say, initially, this is the scenario. Initially, founder one, he had 5,000 shares, founder two, 5,000. Existing investor, the previous investor, he had 2,500 shares and he held 18.5%. Okay. Now, if a new investor was offered 2,000 shares, okay, at 8 lakh rupees. Now, this guy got 2500 shares for 20 lakh rupees, which means he got it for 800 rupees per share. Now, the new guy is being offered 2000 shares at 8 lakh rupees only, which means he is getting them at 400 per share, right? Seedha half ho gaya value. So the new investor is getting shares at half the price of the existing investor. So what will happen? How anti-dilution will be? So there is this formula based on which, so there's an adjusted conversion price. So what will happen is put in the values, the adjusted CP will come into this. So the existing shareholder will get whatever value he had invested divided by this, which is equal to 2672 shares. So he earlier had 2500 shares. Now, the anti-dilution kicks in, and now he will have 2672 shares, right? So that's how he is, protected to a certain extent against, devaluation of his money in the case of a downer. Okay. And the difference between a broad-based and narrow-based formula is, in this formula, the unissued shares are also considered for calculating, whereas in a narrow base, the unissued, which is typically ESOPs, are unissued, right? They are not considered. Okay. Now, transfer of shares. This clause basically has these special rights which are given to the investor for his shareholding. So he gets what is called a tag along right. So what a tag along side right basically means is that, let us say I am an investor, I'm holding 20% shares. Same example. Now, one of the founders, uh, he wants to exit the company, okay, and he wants to sell his entire 40% to a new investor. Now, the tag along right says that the investor will get the right, and again at his option, to tag along with the that founder. तो वो बोलेंगे कि भैया तुम तुम्हारे शेयर बेच रहे हो, ठीक है, तो तुम्हारे साथ मेरे भी शेयर बेचो proportionately. Okay, so whatever, let us say he was going to sell 100 shares. The founder, one of the founders, was going to sell 1,000 shares. उसमें से 20%, okay, 20%, which is 200 shares, ये investor के उसको बेचने पड़ेंगे. So he gets to tag along in that deal, जिसमें वो founder who had a 40%, वो उसके बेचेगा और फिर इन्वेस्टर के 20%. So out of the investors holding of 2500 whatever shares, he will be able to sell 200 odd shares out of that. Okay, so that's a tag along right. Again, so why this right? See, investor comes in with the understanding that, okay, these founders are going to remain, and they are going to run the company. They are the ones who are the experts at whatever that company is doing. So I will be in the company as long as they are there. अभी अगर फाउंडर खुद ही अपना शेयर बेच के निकल जाने लगा, तो देन इन्वेस्टर भी बोलेगा कि नहीं बॉस, इफ यू आर नॉट गोइंग टू स्टे, आई आल्सो डोंट वांट टू स्टे. So if you are selling your share, you'll also, I will tag along with you and sell a part of my shareholding also. Okay. So that's a tag along right. Right of first refusal. Okay, so right of first refusal means that the investor or the founder ability to purchase the shares of the selling shareholder before anyone else or third party can. So what happens is, again, same scenario. Let us say the founder wants to sell 1,000 out of his 5,000 shares. Okay, the right of first refusal says that he will first have to offer those shares to the other shareholders who have this right of first refusal. Only when they refuse to purchase those shares will he get the right to sell them to any third party. Okay, so the only condition is that if whatever price the third party is ready to offer the selling shareholder, the shareholders who's exercising this ROFR will have to offer at least that price or higher. Obviously, because if I'm getting 1200 rupees per share, you can't say, boss, I will pay you only 1000, but you'll have to sell to me. That's not fair. That's not logical, also, right? So I'll say, okay, you want to sell your shares? Okay, I'm ready to buy them. तो तुम किसी और को मत बेचो. तुमको वो कितना दे रहा है, 1200 रुपया दे रहा है, चलो मैं देता हूँ, but you sell it to me first. So that is a right that the investors look for. That's called the ROFR, ROFR or ROFR or whatever. I mean, it's called like that. Okay, so that's a right. These are some of the rights. There is also the ROFO. Right now, what is ROFO? Now, what happens is the investors. This is the investors and abilities. Founders' ability to allow the securities before selling shareholder tries to sell it to someone else. Here, the seller has to approach the investor or founder prior to going to any third party. Okay, so it's slightly similar to that of an ROFR, where you have to first offer to them and then to someone else. You cannot even offer to anyone else. Okay, you first have to offer these. So that's the ROFO. Now there's something called a pro rata right. Okay. Now pro rata right is, let us say in the previous example, I first bought 20% equity in the company in a previous funding round. This investor. Now,
may I ask one question, sir?
Yes.
So in ROFO, the investor going to somebody else to tap what price he can get, he has to approach the founder, right?
No. So basically, these are all shareholders, right? Now, if any of the shareholders, it might be the founders. Now, in our example, there's only one investor, and he is the one who holds this ROFO or ROFR. There might be multiple investors also, correct? So they are all basically shareholders. Now, if any of these shareholders, ROFR में क्या होता है? ROFR में the whoever wants to sell, वो market में जाता है, वो रेट निकालता है, ठीक है? वो बोलता है कि भाई मेरे को बेचना है. He'll go into the open market. कोई seller उसको, buyer, potential buyer उसको आके बोलेगा कि I will give you, like we saw, 1200 rupees per share.
Right.
ठीक है? तो उसने प्राइस निकाला. But he'll say, boss, one of my investors has a ROFR. ठीक है? So you give me an offer of this 1200. I will first have to go to him with that offer, your offer, okay, right, and give him the first right of refusal. तो क्या होता है कि he already has a price discovery हो चुकी है, right? So he will go to the investor then saying, sir, मेरे को एक buyer आया है, वो मेरे को 1200 रुपए दे रहा है, ठीक है, तो आप मेरे को दोगे क्या? तो इन्वेस्टर, इफ ही इज इंटरेस्टेड इन बाइंग दो शेयर्स, वो बोलेगा हाँ भाई मेरे को खरीदना है, मैं तेरे को देता हूँ 1200 रुपए, यू सेल इट टू मी. इफ ही सेज नहीं, मेरे को नहीं खरीदना है, तू जा बेच दे, then only he can go and sell to that potential buyer. Okay. ROFR. ROFO में क्या होता है? राइट ऑफ फर्स्ट ऑफर. मतलब वो पहले थर्ड पार्टी के पास जा ही नहीं सकता है. सो इन ROFR जो क्या हुआ कि वो पहले थर्ड पार्टी के पास गया, प्राइस निकाला, फिर वापस आया, फिर बोला कि भाई मेरे को ये प्राइस मिल रहा है, मेरे को दे रहे हो क्या? वो बोलेगा, जो whoever is ready to offer, he'll offer that price and he'll buy it. ROFO means he will not even go to a third party. He will first offer his shares for buying to the existing shareholders or the shareholders who have this ROFO. This right of first offer. Okay. So the price discovery hasn't happened. Let us say I only want to sell, but okay, I set the price. I'll say, okay, you pay me 1200 rupees, you pay me 1100 rupees. Oh, and then, it's the direct negotiation between the both of us. And whatever price is, finally agreed, okay, I'll buy. Or if I'm not okay, to buy at the price that you're offering, then you go outside and offer at that price. But then the condition reverses. जो price मैं तुमको offer कर रहा था, let us say you wanted to sell at 1300, okay, I was willing to pay you 1200. You said no boss, I won't, sorry, नहीं हो पाएगा. So then I say okay, ठीक है, you go ahead. Then you go outside, then you can't sell for 1200 to some third party. Then you will have to sell for anything higher than 1200 because 1200 तो मैंने पहले offer किया ना आपको. So that is the difference between the ROFR and ROFO. First offer and then first refusal. Okay, so like this says, the seller has to approach the investor founder prior to going to any third party. That's the ROFO. Now, pro rata right, I think we're a little short of time. We'll quickly run through the rest of the clauses. Pro rata right basically ये बोलता है कि whatever percentage of shareholding I have right now, let us say if the company is issuing fresh shares and selling them to a potential investor, I say मेरा जितना अभी का शेयर होल्डिंग है उतना that portion of your new issue I will buy again. इसका मतलब क्या होता है? Why is this? So that my shareholding in terms of the percentage is preserved. Pehle there were 10,000 shares out of which I held 2,000. Okay, so my shareholding is 20%. Now let us say if you go ahead and you issue fresh 2,000 shares. Now the total shares will come to 12,000, which means my 2,000 shares will be less than 20%. 2,000 divided by 12,000, right? 1/6 हो जाएंगे 1/5 की जगह पे. So to maintain that 1/5 का ratio, I'll say out of those 2,000 also, I will also buy 20%, which is 4,000, 400 shares. So my shares will then become 2,400. Again, 2,400 divided by 12,000, again 20%. तो वो 1/5 मेरा preserve हो गया. So that is a pro rata, right? And this is again up to the discretion of the investor. He may or may not exercise. This is all, at his option. Preemptive rights, again, investors' right to participate in future financing round. The founder to ensure that this is associated with pro rata right, right? So preemptive right is again that whenever you issue fresh shares, first you offer to me also, along with some fresh investor. Okay. Yeah. So there's a lock-in, vesting, and ESOP. What is a lock-in? So what happens is, let us say there are two founders, same example, both are holding 50-50%, and an investor comes in, he acquires 20%, and then the founder just sells off his 40% and goes away. The new person who's going to come in, he's going to be completely new to the organization. He may or may not bring the same value that the original founder was adding to the company, right? So what investors do is they say, see, founders will not be able to sell their share for, let us say, 2 years, 3 years. So wo aapka, that is called a lock-in period for the founders. And there's also vesting. Now, what is a vesting? Vesting ये होता है कि जिसमें so again, taking the previous example, we'll just go to so there's a founder vesting. So founder vesting, what happens is, let us say I had 100 shares, okay, to begin with, as I am a founder, like all of you, right? I have 100 shares of the company, okay. Now, typically what happens is, there's something called a cliff period, okay, which means that, so the 100 shares which I entirely owned, okay, go back to the company, and then they are periodically vested in me over the next 3 years, 4 years, whatever period is agreed between you and the potential investors. This is basically to make sure that the founders stay with the company for long and work for the company, so that in the best interest of the company. वरना वो क्या है, वो फंड रेज करेंगे, अभी वैल्यू तो अप्रिशिएट हो गया, अपना परसेंटेज या जो प्रोपोर्शन था शेयर होल्डिंग था वो बेच के निकल गए, राइट? सो दैट शुड नॉट हैपन. That's why what happens is this cliff, let's say typical market terms, इसमें क्या होता है कि founder vesting होता है over 4 years with a cliff period of 1 year. So till the end of the first year, the founder does not get any shares, which means that whatever he was holding before investing, वो वापस पूरा कंपनी को चला जाता है, उसका शेयर होल्डिंग हो जाता है जीरो. एट द एंड ऑफ द फर्स्ट ईयर उसको मिलता है whatever the first installment. But till the first 12 months, as this table says, the shares vested in him is 0%. ठीक है, तो वो एक साल तो उसको कम से कम काम करना ही पड़ता है. ओके, now over the next let us say 13 to 24 month period, the out of his 100%, one third will be vested. Okay, so 33.33%. अब ये भी क्या होता है, let us say this is also divided over the 12 month period, and every month आपको इस 33.33% का 1/12 इतना shares थोड़ा 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 करके मिलते जाते हैं. Similarly, it happens over the a 4 year period, and actually at the end of the 4 years you actually get the 100%, and this is not 100% of the total equity. This is just what you are anyway holding as a founder. तो जो 40% है जो आपके पास था in the original example, which was 5,000 shares, आपको वो 4 साल काम करने के बाद, कंपनी के साथ रहने के बाद, वो आपको 5,000 shares मिलेंगे. Okay, so that is called a founder vest. So at the end of the first year, founder shall not have any shares, but vesting of shares shall start after 1 year, depending upon the vesting frequency and schedule. Okay, so this is what a vesting is. ESOP, we all know ESOPs. They are, a very, very important incentive that startups offer or can offer to their early employees, because, startups are not very cash rich. So they compensate for the, lower salaries by offering ESOPs to their key employees, or the employees who they feel are adding the most value to the company. So, but for that, they will have to set aside a pool called the ESOP pool. Typically 10 to 15% of the total equity investors ask, and this is also a condition which happens where the term sheet will say that the startup will have to create an ESOP pool of 10%. Okay, so the cap table cannot simply be okay founder का 40% और investor का 20% हो गया 100%. वैसा नहीं होगा, वो आपको 10% ESOP के लिए रखना पड़ेगा, and that will go out of the shareholding of the founders. तो founders का हो जाएगा 35%, इन्वेस्टर का हो जाएगा 20%, एंड देन जो बचा हुआ 10% है वो जाएगा ESOP पूल में, एंड उस 10% में से आप इशू करते रहेंगे ESOPs to your employees as and when they come in. And then obviously ESOP is an entirely different subject by itself, right? So that's ESOP. Now board of the company, like I said, major investors and investors who have expertise in a particular area, in which, let us say, your startup is operating, might ask for a board seat. This is important from 2 points of view. This is the most important of them being to exercise control over the startups, right? So the founders have to make sure that there's a proper balance between the investors and them in the board composition. We have seen an example where, two investors came in and they took up 2 board seats. Now there were only 2 founders. अभी इन्होंने टर्म शीट में डाल दिया कि भाई हम दोनों एक साथ आएंगे, हम दोनों को एक एक बोर्ड सीट आप दे दीजिए, एंड 2 फाउंडर्स के बीच में एक बोर्ड सीट. So there were only 3 board of directors on the director board, out of which 2 are the investors. Understand how this impacts you. Whenever the company wants to take any decision, how is it taken? It's taken through a directors meeting, and then a shareholders meeting, right? A resolution is passed, and then a voting is done. If the investors form a majority of the board, they will simply take every decision as per their own discretion, and the founders will be left with no say in the running of the company. The founders themselves will become minorities, right? So that is why the board composition is extremely important. You have to be very, very careful, very, very selective in giving a board seat. You cannot just offer a board seat to every investor who comes in, even if they might ask for it. That's something which is, you need to negotiate. Okay. Now there are something called reserved matters. Reserved matters are basically special rights where the investor says that there's a list of different decisions that the company makes. The investor says if any decision pertaining to these matters is taken, then we will we will have a say in it. Okay, or we will get a veto, which means that if the investor says no for that particular decision, that the company cannot take that decision. So it's a veto right that the investor gives himself. This is not in all decisions. This is in very, very specific decisions. Now, what are typically these decisions where the shareholding or the value of the shareholding of this investor gets affected in any way? So, if the company is issuing, let us say, fresh shares, if the capital structure of the company is being changed, if the major line of business of the company is being changed, in a way that it might affect the growth prospects of the company, the investor will say, boss, I need to have a say in this. And if he's not convinced that this is in the best interest of the company, he will say no, and then the company cannot go against it. Right. So, and again, for giving these veto powers, there is a threshold. So not every shareholder gets these veto powers or investor gets these. You have to have a substantial shareholding. Obviously, if I'm holding 2% of shares और मैं अगर veto power लेके बैठ गया in major decisions, तो company चल नहीं पाएगी, right? So it will be disproportionate to my shareholding. In that case, the company or the founders, you as founders, have to be very careful on whom you are granting these rights. Right? And again, exit rights. Now, obviously, like I said, professional investors are investing in your startup not because they love you or your organization or the company or the product or service that you are offering. They are investing in you because they see that you will give them an exit. What is an exit? An opportunity for them to sell their shareholding at a huge profit. Right? So how does this happen? This happens by acquisition of the investor shares by a third party, which is also called a strategic sale. It happens by buyback by the company or founder. So uh, let us say there's a threshold, there's a period, there's a specific period. I say, boss, okay, I'm putting 20 lakh rupees, लेकिन मेरे को 2 साल या लेट से 3 साल के अंदर आपने मेरे को एग्जिट देना है, which means that ये 3 में से एक अपॉर्चुनिटी आपने मुझे प्रोवाइड करनी है. या तो you raise external debt where you give me an opportunity to sell my shares to some third party, या तो you buy back my shares, okay, at some valuation, or you go for an IPO, which is like the ultimate dream of every startup, right? So and then the investor may also ask for a drag along, right? So what is a drag along? A drag along, टैग अलोंग में हमने देखा कि अगर फाउंडर अपना शेयर बेचना चाहता है किसी और को, इन्वेस्टर बोलता है भाई मेरा भी बेच. A drag along is the exact opposite of that. Drag along में ये बोलता है कि see now again coming to our previous example, इन्वेस्टर को अपना 20% बेचना है कंपनी में, okay, but and he finds the potential investor, new investor or a buyer, but that buyer says, boss, I will only buy if I get 30% equity. अब इन्वेस्टर के पास तो 30% है नहीं, he only owns 20%. तो drag along में he will drag along the founders till the time that that 30% is formed. So he will force the founders to sell a part of their shares also for facilitating his exit. That is a drag along right. Okay. Yet, typically this is done by majority shareholders. Obviously, if I am holding a very, very minuscule percentage. I can't force majority shareholders to sell their shares just because I want to exit. तो उसमें भी एक threshold होता है. So basically, the company, you as a startup, have to provide an exit to the investor through any of these opportunities. Okay, so that's a exit right. This is also specified in the term sheet. Now these are miscellaneous terms. There's a no shop clause. अभी we are Indians. We will go out into the market. नारियल भी खरीदना हो तो 4 दुकान में जाके पूछेंगे, जो सबसे कम दाम में देगा वो अपन उससे लेंगे. वैसे ही when when you as startups are going out to raise funds, you will also approach 5 different potential investors. जो आपको बेस्ट टर्म्स देगा वो उसके साथ आप जाएंगे, राइट? या तो आप ये भी कर सकते हैं कि you get an offer from one investor, you show that offer to someone else. देखो बॉस, मुझे ना 20% के लिए 20 लाख दे रहा है, बोलो आप 30 लाख दे रहे हो. So this is called shopping. No shop clause says that the founder shall not parallelly negotiate with other investors while this negotiation is still going on. ठीक है, एक बार मैंने बोल दिया कि no, I'm sorry, I'm not interested in this deal, then you can go and you can negotiate with other investors, but not until that time. Confidentiality: all the terms of this term sheet shall not be disclosed. All or any of these terms of this term sheet shall not be disclosed to any third party. This will remain between you and, like I said, right? आप वो term sheet लेके किसी और investor के पास जाओगे, बोलोगे sir, these are the terms, these are fantastic terms that I'm getting, you give me better terms and then we'll do business. You cannot do that. Okay. And then binding nature. So a term sheet uh, may be non-binding or it can be binding also. It depends on the parties. If it's binding, both parties have to act upon it and see it through to its logical conclusion. They have to execute the final documentation and the investment must happen. Non-binding may, it's okay if that, but the no shop clause, the confidentiality clause, these remain binding under all conditions. Confidentiality, no shop, ये रहता ही रहता है. Even if it's a non-binding term sheet, it is not entirely non-binding. Confidentiality and no shop clause are binding clauses. So you have to keep that in mind. Okay. Yeah, that's about it. So we've tried to cover almost 90% of the terms have been covered. I think our time is also over.
Yeah.
If at all any questions, I'll be happy to take.
Yes. Thanks, Hemant. Actually, yeah, a lot of new terms we came to know about it, like anti-dilution, tag-along right. So it's good for all startups. I think you try to cover everything. I think some questions are also asked in between. So if any startup have questions for Hemant, we'll continue. Otherwise, we'll close it. And of course, they
And you
can come
can
back.
feel free to reach out to me in case of any doubts.
Correct. Correct.
I will be sharing this PPT
Yeah.
with Uday, and
Sure.
it has my mail ID. I'll also share my personal mail ID.
Yeah.
You can write to me. You can call me in case of any doubts or queries that you have. Either about the previous session, which is the legal due diligence, or about term sheets, or fundraising in general. Absolutely. I mean, I'll be more than happy
Yes.
to take all your queries.
Thanks again, Hemant, for your time. And actually, it was very informative. Yes.
Thanks a lot. Thanks a lot, Uday.
Catch you soon.
Thank
Catch
you
up
for this
soon. Yeah.
opportunity. And thank you for all the people who have been patiently listening to me,
Yeah. It
going
was
through
interesting.
all this complex stuff.
Thank you.
Thank you so much.
Thank
All
Thank
you.
you.
right.
Bye.
Thank you.
Bye.
Thanks a lot.
Bye.
Yeah.